Hello, everyone. I'm Don Prattle from TradeStation, and it gives me great pleasure today to welcome Dave Lerman of the CME Group for this very special TradeStation University event. David is going to review for us the leading metals product and offer products offered at the CME, and offer plenty of reasons why traders should consider hedging their positions or trading metal futures at the CME Group. Some of the fundamentals and the drivers will be discussed, as well as hedging and trading strategies will be explained in detail to help traders deepen their knowledge and improve their understanding of these markets. As a special bonus today, Dave's also going to describe CME Group's Ready, Set, Gold trading competition. And I'll leave that for him. There's a couple of little extras that we want to provide you with in the way of getting started with the contest. Our presentation today is for educational purposes only. None of the information that we're going to pass along here today should be considered a recommendation of any kind. As this disclaimer points out, and the disclaimers that I posted in the chat panel point out, that any of the materials that we discuss today should not be considered as an offer or a solicitation to buy or sell financial instruments, provide financial advice, or to utilize our trading platform for anything other than informational purposes. So, without further ado, at my desk here at my desk here, we will. I'm going to pass the microphone over to Dave Lerman, and he will continue on with his presentation. So, Dave, thank you very much for coming to TradeStation.
My pleasure. My pleasure. And on behalf of the CME, I'd like to thank TradeStation for having me on. And it's always a pleasure to work with all of our firms. And hopefully today's presentation will be, everyone will walk away with something here. We have some basic stuff, we have some more intermediate material, and so like I said, everyone will walk away with something here. I want to get into a couple things real quickly though, but hold on, before I do, I want to make sure that I can flip slides and stuff like that. And how do you get the slides to flip? This one, okay, perfect. Okay, like Don said, we have a gold challenge that we're coming up. It's a trading competition. It's called Ready, Set, Gold. They have information on it on the TradeStation website that actually advertises this seminar. It's a 5-day competition where you can trade gold, silver, and platinum and palladium, and you'll have a beginning account size. I believe it's going to be $100,000 or something like that, and there'll be 3 top prizes. So, for example, gold, silver, bronze, or whatever, and they'll offer money. So you can win up to $2,500 cash, and it's great. So you can just test your skills on the trading challenge coming up in the middle of March here. It starts March 11th, Sunday at 5 o'clock, and we'll have little educational snippets all throughout the week, and some highlights and some learning moments about gold and the metals market, some of which are going to be highlighted here in the seminar that I do now. You can go to institute.cmegroup.com/gold to log in. You have to register for this and get yourself familiar with the trading simulator and things like that. But I believe you'll have a $100,000 fake account, and prizes go to the top 3 people that make the most money, the top 3 money makers, so to speak, top 3 in profitability. So let's get on to the webinar now, and trading the metals complex at CME Group. We're going to speak mostly about gold, but in my webinars and seminars and presentations, I like to talk about spreads a little bit too, because it'll get your finger on the pulse of the markets a little bit more. You'll learn one market versus another, why there's price discrepancies and how to take advantage of these price discrepancies. It also changes the risk-reward outlook for a trade too. It's different. It's a little bit more difficult trying to predict something going up or something going down. With spreads, though, you don't have to get your arms around being right. You can just add this disparity. The spread has to either increase or decrease in the direction that you trade it at. Some of the very best traders I know that have staying power in the markets and stick around for 20 or 30 years trading futures, one of the reasons they do so is because of spread trading. Ditto for options. A lot of options traders are a lot of the excellent options traders that I'm aware of, they don't just speculate outright on puts and calls. They always do some kind of spread, a bear spread or a bull spread, or some combination like a straddle or a strangle, or a combination with futures and options. So spreading is something I like to talk about, and we are going to spend a good 10-15 minutes of this webinar on that. Okay, so we're just going to have a quick summary here of the top 10 reasons why you should consider trading metals futures at CME Group. First of all, the cheap execution costs. If you look at pound for pound, you compare the execution costs of trading futures with their notional amount size with other types of instruments, whether it be stocks or options or mutual funds or ETFs, you'll find that futures compare very, very favorably. So it has to do with lower commission costs in general. It has to do with the bid-offer spreads. It has to do with top 10 reason number 2 also. They're very, very liquid. Usually the minimum bid-offer spread for a futures contract, if you look at the top futures contracts like a gold or a silver contract, the minimum bid-offer spread is usually 1 tick. So you combine the fact that these have large notional values. The gold market, the gold futures market is a $132,000 notional value contract. So the commissions that you would pay are a very small amount of that notional amount. And the bid-offer spreads are always 1 tick, maybe 2 ticks in some case, unless you're doing a large order like a 100 lot or a 200 lot or something like that. So cheap execution costs is probably the number 1 reason why you should consider trading gold futures, or any future for that matter. Liquidity is also pretty unparalleled in the metals complex. Both gold, silver, and copper all trade over 100,000 contracts a day, and gold trades over 200,000 contracts a day. Actually, its average daily volume is in the 300,000 a day. So it's one of the mega contracts right up there. Not as liquid as the mini S&P, but it has solid open interest and really, really good and respectable volume every day too. So pretty efficient in terms of liquidity and execution costs. The number 3 reason would be capital efficiencies, and I also call it a reasonable leverage. Again, gold, the futures contract has a notional value, a contract size of about $135,000. You would only put up $4,000 or $5,000. That's the exchange, the CME Group exchange minimum margin. I'm not certain what TradeStation's minimum margin is. You can check with the folks there, but it's probably similar. The firms, such as TradeStation, would be allowed to charge a margin slightly larger or even significantly larger than the exchange minimum. They don't often do that, though. It depends on the account size, credit worthiness, and the volatility in the market. But in general, they're pretty much in line with the CME Group minimum margins. And that, with the gold, you're only putting up 3 or 4% of the underlying value of the contract. So you get reasonable leverage, and that's good. Capital is precious, capital is expensive, and you want to make sure it goes far and you can spread your opportunities around and have a diverse portfolio, if you will, trading. 4th reason is 24-hour trading, and this is really important, especially in the metals market. The metals market, along with the currency markets, are true 24-hour markets. If you look at the major financial centers around the world, New York, London, Paris, Hong Kong, Singapore, Tokyo, they all are very, very large trading centers for gold. There's a daily trading fix out of London for gold. New York's a major place. That's where the commodity exchange, which is part of the CME Group, is located. And Tokyo also trades a large amount of gold. So all the major financial centers, it just passes from one time zone to another. So it's a 24-hour availability, and with our Globex matching engine available 24/7 basically. We're not open on Saturdays. It's more like 23/6. We're closed for about an hour every day for system uploading and downloading and maintenance and things like that. Uploading and downloading of orders and system maintenance. So if you want to put a trade on at midnight, you can do so. And liquidity is pretty good because gold, about 40% of our volume in metals, occurs in non-U.S. hours. So a lot comes out of Asia and a lot comes out of Europe, obviously. So there's some really, really good and liquid. Liquidity is usually good during the U.S. time zones in many of our futures contracts. But we have really good liquidity overnight in some contracts too, and gold would be one of them. There's also some strategic reasons too. There's things that you can do in the metals market and futures that are difficult, next to impossible to do in the stock market or in the ETF market. So for example, if you wanted to spread gold versus silver or gold versus platinum, you can do it with the ETF market, but it'd be much more expensive in terms of margins and capital outlay. You can do this using the mining stocks. However, mining stocks are even more leveraged in certain ways. When metals go up, mining stocks sometimes go up a lot more. And when the metals prices go down, mining stocks sometimes go down a lot more. But there are also days when like gold would rally and some of the gold stocks wouldn't rally at all. Just has to do with marginal cost of operating a mine, and there's strikes, there's labor strife and things like that. And some of these mines are in countries where there's just instability, political instability. So as a result, the mines will sometimes, the gold mining stocks and silver mining stocks will go a little bit different direction than the metals futures. So you need to be aware of that. Which leads to number 6. It's a pure direct play on the markets and asset classes. So if you wanted to take a position in metals, you thought gold was going to rally dramatically, you can do it with an ETF, you can do it with mining stocks, but then again, there's not a direct correlation. The best way to play any commodity is to do it through the futures market because you'll get a 1-to-1 correspondence. If gold were to go up 20 bucks an ounce, it's very likely the futures were going to be going up 20 bucks an ounce. You wouldn't necessarily get the same percentage gain in the ETF or in the mining stocks. So be careful there. It's a pure direct play. Same thing, crude oil. People call me up and they say, Dave, should I play the crude oil market? I'm bearish on energy. Should I do it with the XLE ETF? Should I do it with ExxonMobil? The best way to play crude is to play it with crude oil futures, I believe, because it's a direct correlation. It's a direct market. You can play it with ExxonMobil, but that's a gigantic corporation, a $300 billion market cap corporation with upstream, downstream, midstream, and all sorts of gas station operations, chemical operations. And when crude goes up $1 a barrel, it doesn't necessarily mean that ExxonMobil is going to follow suit. So one of the purest ways to play the futures market is the actual commodity markets is in the futures markets. The 7th top reason is supply and demand, smoke and mirrors. You don't have to worry about any accounting issues like we've had in some companies. If you look at some of the companies in the Russell 1000, some of the metals companies, some of the energy companies, there's accounting issues you have to deal with that can sometimes send a stock up or down dramatically. You can't measure supply and demand. There's also been some accounting frauds in the past. If you look at MCI WorldCom and Enron, big blow-ups there in terms of accounting frauds and things like that. When you play the metals market, it's a multi-trillion-dollar market. I think all the gold in the world that's been mined equals somewhere around $6 trillion, I believe. Be really tough to have any kind of manipulation of the price of that. It's such a big market. It's held by so many players, central banks included. So that's something that you need to keep in mind. You don't have to worry about any accounting issues because you're just dealing with a commodity and a metal that's just dug out of the ground and usually stored in a vault or used in electronics or in jewelry. So it's more of a pure supply and demand product. The 8th and probably the most important reason is we'll just call it the CME clearinghouse, which is crown jewel of the CME. Basically, every trade that's made every day is cleared. And if you make money or lose money, that money is debited or credited out of your account every day. And the CME clearinghouse is the one that also sets margins in conjunction with the FCMs. They make sure that money is paid and collected accordingly. And they also set margins, they set maintenance margins, and they do all the risk mitigation for the exchange. And they do this for not their own health. They certainly do it for the exchange, but they also do it for the firms such as TradeStation and for their customers. So when everybody's on board, you have just a much more safer and much more credible market. And risk mitigation is very, very important. And it's something that traders pay a lot of lip service to sometimes. They learn about profits, they learn about loss, and if you're early on in your learning curve, learn a lot about risk management because it's said that if you don't know about risk management, the futures market will be a painful lesson for you if you don't get it. So it's a good idea, and one of the things that makes it easier is the clearing firms or your brokerage firm like TradeStation or the clearinghouse, they will impart risk management to you. So you're going to have to learn it. So that's a good lesson. So you'll have financial safeguards. We have price limits. We have position limits. There's all sorts of things that the clearinghouse does to mitigate risk and keep it to the minimum. We can't control the price of gold. We can't control whether it's going to be trading at a 15 standard deviation or a 10 standard deviation or 10% volatility, so to speak. but we can control the amount of money that you would put up. We can control the amount of positions you put on, and price limits in terms of futures contracts. The ninth reason, if you look at some of the greatest traders of all time, some of the more successful hedge funds out there and CTAs and some of the large pension funds and things like that, they trade futures contracts, and they do so as either part of a hedging program, part of an asset allocation program, and they like the 24-hour nature of futures, and they like all 10 of these reasons too, and that's one of the reasons why they trade a lot of metals complex. And the 10th reason, futures are a first responder. There's an 11th reason, too, about its tax efficiency. Futures are traded with the 60-40 rule under the IRS. In other words, if you make $10,000 trading futures, gold futures, you would 60% of the gain would be long-term capital gains rate, which is relatively low to ordinary income, and 40% of the gain is treated with ordinary income. The blended rate's somewhere in the low 20% area. So if you were to make the same $10,000 trading GLD, the ETF, or trading mining stocks, and you did it was a shorter term trade, you would pay ordinary income. So in the top tax bracket, that could be 39.5%. Whereas with 60-40 treatment under the IRS rules, you would only have to pay in the mid to low 20s would be the blended rate. So let's move on here. Now, just a little quick summary here of the volume of all the futures contracts and the open interest, and also our options. This is the metals complex. So you can see gold trades 316,000 a day, copper about 111,000, silver nearly 100,000. Platinum and palladium are decidedly less liquid, but you can still get a lot of orders done. You can still get trades done there. And they're popular contracts because of what's going on. They're industrial metals as well as precious. Platinum's used in jewelry, but it's also, as we all know, used in the production of catalytic converters for automobiles and pollution control. And palladium, the same thing. One is used, I get them mixed up. I think platinum is used more for diesel engines, I believe, and then palladium is used more for gasoline type engines. I may have that reversed. So, but either way, gold is at the top of the leaderboard, so to speak, not only in open interest, but in average daily volume. If you go over to the last two columns, you can see the open interest with options. Gold options, the open interest is over 1 million. So that's pretty incredible, very liquid. Average daily volume is around 45,000. So it's running around 15%, 12% of gold futures. Copper futures is an anomaly, and we're looking to take care of that. And we've instituted a couple of initiatives, one of them being a large market maker program. So options on copper futures. Normally, when you have something trading 100,000 contracts a day, 10% of that, 12% of that would be options volume. And so that would equate to about 10,000 options contracts, options on copper futures. But we just initiated this market maker program in July of last year, and we're up to 1,000 a day, a couple thousand a day in some cases, and open interest is well into the 5 figures now. So we're looking for that to grow dramatically, and at some point catch silver, which does about 7,000 a day in options and has 109,000. The next slide is pretty much the same thing. It's a little bit smaller print to read, though, there, but it just has some of the contract specs. But don't worry, we're going to have that later on. We're going to talk more about the contract specs, especially in gold and platinum. All right, just a couple of fundamentals that we'll go through really quickly before we get into contract specs and trading spreads and stuff like that. Most of the demand for gold comes in 3 sources. It's jewelry, industrial demand, and investment demand. Jewelry is about 40 to 50%, depending on what year it is and how much involved India is. When there's a drop-off in India, there's a significant drop-off in demand. They use a lot of gold. Industrial demand is about 10%, mostly electronics, appliances and things like that, dentistry. Investment demand is another 40% too, and that's usually people buying bars, gold coins, or exchange-traded funds buying large amounts of bullion. And then, of course, that all-important central bank purchases. They're about 7% of physical demand back in 2016. We won't have the 2017 numbers for a while. Suffice it to say, they change a lot. Central banks get into gold, get out of gold. Watch out for the rumor mill when you hear about China central bank buying gold or this central bank selling gold. It may or may not be true, but if you trade on fundamentals or technicals, either way, It's hard to determine what a central bank is doing. It's not something that they would telegraph. So be careful when you read things in the paper about that. A little up more about the supply overview. There's a combination of just regular old mining supply, and then gold is sometimes mined as part of scrap, and vice versa for silver too. Sometimes you mine for gold, you get silver as scrap. There's other metals too where you get a 2-for-1 deal supposedly. If you mine one metal, you get some of the other two. You just get dramatically less of it. Central banks were net suppliers of the market, but turned net buyer in 2009, and I think that stays to this day. It's produced on every continent except Antarctica. It's amazing. I wonder if anyone's ever drilled in Antarctica or mined to see if it is there. It's a little dry and a little cold, but I would imagine that this is right, that it's not in Antarctica, and be very costly to get it out of there too. The top mining supply countries, China, Australia, Russia, and the United States. We hold the largest amount of supply, those 4 countries. The top supply from scrap comes from China, India, Turkey, and Italy. Short-term price drivers, the dollar has a lot to do with it. When the U.S. dollar makes a very large move, it will impact gold. Stronger dollar dampens the metal's appeal. A weaker dollar, it's the opposite. Just makes it more expensive for other currencies in some cases if it goes the wrong way. Interest rate expectations are another thing. Gold and interest rates tend to be negatively correlated. Gold, well, I take umbrage with this a little bit. Gold is non-yielding and has historically been viewed as a store of value. I agree it's a store of value. Higher yields diminish gold's appeal. There is a way to get some yield out of gold. If you know the options market, you can sell options on gold futures and get some income. The problem is there's a little bit of logistics. If your option gets exercised and you get a futures called away from you, you're going to have to go into the market and have a futures contract ready to go. Or if you sell puts, you're going to have, at any point in time, if you get exercised, you may have a futures contract put to you. So that's something you have to take advantage of or be careful of if you were ever going to do this. But gold can produce yield if you wanted to sell options on it. It's just something, one, you have to have a good understanding of options. Do not do this without doing your homework. And you have to get the logistics around with your futures broker and your futures account in terms of what would happen if you get exercised. All right? And it's just a totally different game. Options are 4-dimensional. Futures are 2-dimensional. When you buy or sell a futures contract, you only care if it goes up or it goes down. When you buy or sell options, you care about up, down, time to expiration, and volatility, as all 4 of them will affect an options price. Geopolitics, volatility, as we all know, gold's viewed as a safe haven, though not always. It looks like the world's falling apart, and gold falls apart. Look at the price of gold during the financial crisis. But anyways, it's no one's liability. It's not like fiat currencies that can be printed ad infinitum, and people take advantage of that. So, and there's lots of volatility. There's in the currencies, not just the U.S. dollar, the European Central Bank, emerging market central banks, all of them have an impact on gold and gold prices and gold volatility. Long-term supply, obviously mining. Primary supplies of gold and silver have stagnated and declined slightly, partly because of big drops in prices in 2014 and 15. We've been treading water for a while now. Gold's been trading between, what, 1,100 and 1,400 now for a couple years, so it hasn't gone too much higher. And where a lot of people are anticipating that it gets back to its old highs of just under 2,000. Obviously, inflation is important in the gold equation, as we all know. It's the real interest rate, though, negative real rates and positive real rates, and how big negative real rates are that has an impact on gold. And if you go to the Merck's website, there's some stuff written, some materials written, white papers on interest rates, real interest rates, and the price of gold. So historically, U.S. inflation has mattered most for gold prices, and during our worst inflationary times is kind of when gold really had its biggest rally from $200 an ounce to $875 an ounce back in the late 80s, or late 70s and early 80s. Oil prices also, historically gold and oil, have had some kind of positive correlation. Sometimes they decouple because of what's been going on in the oil market. It's been so volatile because of the major change in the landscape and the ecosystem of the energy markets over the last couple of years, with the United States becoming a really large exporter of oil now, and also just digging up a lot more energy because of technology, and our production has gone up dramatically. I'm going to skip that slide. I'm going to get in, just skip 2 or 3 slides there. Just real quickly, you can see the trends over the last few years. Gold's done, it's pretty good. COMEX gold futures, average daily volume by month. You can see the last year, nice upswing. In general, it was steady from 2001, slight growth up to maybe 2010 to 2015. And then 2016 and 17, we started this upswing in volume, and it continues to this day. Next slide is platinum. And hold on one second. Let me go back. I want to see if I I forgot to put silver in here. It may be the next chart. But platinum, as you can see, different story altogether. Very steady growth in platinum for the last 8 or 9 years, going back to 2010. There's a typo at the top there. This chart goes back to 2010, and it's been steadily going up here. You can see average daily volume in platinum about 5,000 about 8-9 years ago, and now we're up closer to 15,000-20,000. You see every quarter a spike there in volume. That's just the quarterly rolls that we have. And you have that in stock index futures and many futures contracts. But even the spike volumes, the spike highs, you can see them. They're steadily trending upward. So very, very good action in platinum, and a lot more players coming in the market. Plus, what happened with the Volkswagen, the diesel engine scandal. They thought that would dramatically impact platinum and the demand for platinum and reduce it dramatically. We'll talk more about that later. And as a result, volume is coming into the market, again, dramatically in the last couple of years. Part of the reason is that. Again, it's an industrial metal that's used as a catalyst for catalytic converters in cars and trucks. Oh, there's silver futures. Okay, so I just had them out of order a little bit. We had a big spike in silver volume in the 2010-2011 area. Then we leveled off for about 5 years. And then just, again, recently, just like gold and platinum, since 2016, metals have gone higher. So the picture looks bright for metals volume and activity, and we'll see what happens. It'll be interesting to see in 2018 what unfolds for prices and what opportunities will be there to take advantage of. And we'll talk about some of those. All right, so let's look at the contract specs here before we get into a trade or a particular type of trade. It's 100 ounces, so it's pretty simple. The math is very easy with metal. So you have 100 troy ounces with gold. The minimum tick value is 10 cents. So each futures contract at the CME Group has its own individual tick value. Some of them are similar. Some of them are identical. Some of them are really different, like treasuries that have, 31.25 as the value of a tick, and they're trading at 1/32 or 1/2 of a 32nd. These are pretty simple. So it's 100 troy ounces. So we're trading at around 1340 now, 1350, I believe, in gold. So the value of the contract is basically 1,340 times 100 ounces, which gets you about $134,000, which is what I kind of guessed at the beginning of this webinar, too. Minimum tick is a dime or 0.10, and that equals $10. So 10 ticks equals $1 full dollar, which would equal $100. So if gold goes up $1 an ounce or down $1 an ounce, you'll make or lose $100. Goes up $10 an ounce, you'll make or lose $1,000. So when we have these big moves in gold that goes up $20 an ounce or down $20 an ounce, that's a move of about $2,000 on the 100-ounce contract. All right. The ticker symbol is GC. That's a Bloomberg ticker symbol. That's also our main ticker symbol feed from the CME. Some other quote platforms may have slightly different product symbols, so don't let that trick you up. Trading hours, as I said, we're open almost 24/7. We're not open on Saturdays. We open up at 5 o'clock on Friday. 5 o'clock on Sunday afternoon, Chicago time. And we're open from 5 o'clock in the evening till 4 o'clock the next afternoon. So we basically trade 23 hours a day for basically almost 6 days a week. The contract months, we basically have nearly every contract month. That's all I'm going to say. You can look on our website. You can look on your quote screen, your TradeStation quote screen, and you can see. But you have the current calendar month plus the next 2 calendar months, and within any 23-month period, you have a February, April, August, and October contract. So there's plenty of expirations for you to trade, plenty of intra-month spreads. And if you were a hedger and wanted to hedge some of your gold exposure, and you had a long-term or a medium-term or a short-term perspective, there's plenty of contracts out there going out a long period of time. The trading venue is basically CME Globex. So we offer trading almost 24/6 as we talked about. So the match engine's pretty robust. It's almost never down. I've been at the Merc in a couple weeks. I'll celebrate my 30-year anniversary. I haven't heard of a major outage, a system-wide outage, except maybe one time in the entire 30 years. Of course, we've only been trading since 1992. But it's a pretty robust trading system, and that's obviously you want that. There are options available. We have the regular options, we have monthly options, and we have weekly options too. So those that want to take advantage of something that's going on in the market, like we had these Italian and German elections, and you wanted to do, take advantage of it with a weekly option, you can do so. So you can play news events, and you can work on opportunities using shorter dated options too. All right, so the first strategy I want to look at, let's look at gold and platinum, all right? And it's got a very storied history. In terms of a spread, spreads usually are pretty even keeled. They move up, they move down, but not by a lot. Gold and platinum have, like I said, a storied history. They've moved up and down relative to each other, especially platinum, dramatically. And we'll see that when we show the charts of this. But in the text here, all right, so for most of the last 10 years, gold and platinum, they've tracked each other well. But then all of a sudden, a few years back, platinum went to a substantial premium over gold. And now it trades at a substantial discount to gold, pretty significant, not as much as it was as a premium. So as a professional spread trader or a professional trader, what might your thinking be? What's the recognized spread ratio for this trade? And what's the margin offset for this trade? And what's the total required margin to implement this strategy? Remember, these are CME minimum margins. TradeStation may implement slightly higher margins or higher margins too. All right, but we're just looking at this from a standpoint of a trader. What does he need to look at? What kinds of things need to be pointed out? And you see here, platinum over gold, the long term, or platinum versus gold. This is the price of platinum minus the price of gold. You could do it the other way if you wanted to, but you can see there back in the early 1990s, platinum and gold tracked each other very well. The spread went nowhere. Then all of a sudden in 1999-2000, it started to trend upward, and platinum started to trade at a large premium to gold. And then it went to a dramatically higher premium over the next few years. It just kept trading higher and higher and higher. And then it got to a $1,200 premium relative to gold. And that's, again, the growth in the auto industry in China, the growth of the auto industry around the world, the growth of diesel engines, and platinum being one of the main catalysts for diesel engines, I believe. And it just created a tremendous amount of demand for platinum relative to gold. Gold is just pretty much a precious metal. Platinum functions as a precious metal, but also an industrial metal because of its catalytic converter properties. But then an interesting thing happened right around 2008 and 2009. Platinum just fell out of bed completely. And remember, we had the financial crisis. The auto companies around the world struggled mightily. Two of the auto companies in the United States nearly went bankrupt. I think one did declare Chapter 11 bankruptcy. As a result, cars sales went down. Demand for any kind of car, whether it be regular gasoline or diesel, plunged, and therefore demand for catalytic converters, platinum and palladium, plunged. And we saw platinum drop dramatically relative to gold. And gold pretty much, it went down, but it didn't go down anywhere near as much as platinum did. And you can see it had a little counter trend rally. We went from about a $100 premium up to another $600 premium. Then it just fell out of bed in 2011, 2012. And then, of course, then we had the Volkswagen diesel engine scandal where they faked some of the pollution test results and cast a negative pall on diesel cars, and people were thinking, well, they're not as good as we thought, and it just had a major effect on platinum. It had an effect on palladium too, but palladium I think is more for gas engines as a catalytic converter, so that was a totally different spread ideal on its own. And you can see, so it's now back to a discount. I think it's trading a $200 or $300 discount as of a couple of days ago. So it's a spread that people look at. I've seen some large money managers looking at it because they look for platinum to reassert itself to be at a premium over gold at some point. Should the auto industry, particularly the diesel engines, show stronger growth. But As of now, no, it's not the case, but it should be in the long run to intermediate run. It's just one opportunity we're trying to point out here. But how do the mechanics of this work? All right, so now platinum trades at a discount to gold. Clearinghouse requires 2 platinum futures versus 1 gold futures contract. So remember now, platinum is a smaller contract. It has 50 ounces instead of 100 ounces. They trade roughly the same price. So you have to do 2 platinums for every 1 gold, and this is the only way the clearinghouse, the CME Group clearinghouse, will give you a spread credit. And this is the great thing about trading spreads. You don't have to put up all these separate margins. It's not additive. You get a discount. It's called a margin credit or a spread credit. So let's just say you wanted to go long or short. We'll say long in this case. 2 platinum contracts at $1,750 a contract times 2, $3,500. The margin on 1 gold contract is $4,900. The combined margin is $8,400. But you get a margin spread credit of 65%. So if you wanted to do a trade like this, or any spread, gold or silver, platinum versus palladium, gold versus copper, you get spread credits. They just depend on the correlation as to how much of a credit you'll get. 65% credit's pretty good, though. You'll only actually be paying 35% of all of the total margins added up. So it's 8,400 times 1 minus 0.65, which is 8,400 times 0.35, and that's $2,940. So you can do this entire spread trade for less than the margin of a gold contract, and you can learn to play one metal versus another. And this is an interesting concept that a lot of people like to do. Like I said, professional traders like to trade spreads. And platinum has been usually, let me repeat again, usually spreads are not that volatile. They move nicely. You can make good money on them. The good thing about spreads, though, is the risk reward changes a little bit. You tend not to make as much money with spreads, but you also tend not to lose as much money, too. Now, that's not always the case. I've seen people do July-November soybean spreads, and one leg goes limit up and one leg goes limit down, and they have the opposite side of the trade on, and that's very, very painful. In financial futures, usually the spreads do not, if one contract goes up, the other contract goes up too. But in commodities, careful. In some commodities, 1 month could go up, the other month could go down. They tend to go up in concert, but one would go up more than the other, and that is where you make money on a spread. You want one leg to go up or go down more than the other. They tend to move in the same direction, but be careful. But with gold, when we have a major rally in gold, it tends to move up. So with platinum, it's just one would outperform the other, and that's what you hope happens when you're doing a spread. So let's move on here so we can get to some other things. All right, so another trade that people watch is gold-silver ratio. And we're trading right around 80 now, about 80 ounces of silver to get one price to equal the price of 1 ounce. The highest it's ever been is 100. The lowest that we've seen since 1977 is in the teens. So we're pretty high now, and there are some people that think that's an interesting trade too. We get long silver versus gold, so long silver and short gold. We're not going to get into all the specifics of this trade, though, but these are the opportunities that traders are looking for. What metal is trading higher than its other metal, and what metal is trading by a long shot higher than its corresponding other metal? In other words, is gold and platinum out of whack? Is platinum and palladium out of whack? You know, you can look at a chart on these things and get an idea of the highs and the lows, and they trade not cyclically, but they're mean reverting a lot of ways, kind of like volatility as an options. They tend not to go straight up or straight down, although for a while there, the platinum trade looked like it was going straight up or straight down. But it also created a big inefficiency at the top and a big inefficiency at the bottom too, and it allows traders to take advantage of those opportunities too. So if you thought gold was going to underperform silver, you just get long silver and short gold. If you thought the opposite, you get long gold and short silver. Although we're trading near multi-decade high, so that would be a riskier trade just based on percentages. And what's affected silver over the years? Well, as we all know, silver, one of the biggest sources of demand was photography. But, solar panels, you have electronics and batteries, you have jewelry and silverware, and then there was photography was the biggest. Going into the late 90s, 1999, 2000, it peaked in 99 and 2000. Was photographic use for regular old film cameras. And as we all know, Eastman Kodak and other, Fuji and other filmmakers used vast amounts of silver supply to make film. and photographers liked it. But then, as what always happens, we had a change in the way the world works, and we had progress, and we had digital cameras and digital photography, and the need for, as you can see, the need for silver in photographic film plunged from 1999 to now, and it's still heading down. It's finally starting to plateau down a little bit. Super professional photographers still use old-time cameras with regular film, but there's a lot of them have switched to like Nikon digital cameras and things like that. So there'll always be a little bit of demand from photography, but it is continuing on a massive downturn, and that's had a huge impact on the supply of silver over the years. It just hasn't been able to rally because a big amount of demand has come out of the market. But now it's equilibrated. We're back to equilibrium. We got jewelry, electronics, other uses, solar panels growing, and that could change the supply and demand dynamic that would favor silver outperforming gold in percentage terms, and why I brought that spread up. All right, just a couple things here now regarding ETFs, and then maybe one or two other things after that, and then we'll open this up to a Q&A. We thought we'd go about 45 to 50 minutes, then have some Q&A, so we're right on time here. You can see here a colorful chart, gold color, only appropriate for a metals product seminar. It compares the two major gold ETFs to the gold futures. It's CME Group. So we have COMEX Gold. We have the Spider Gold Trust, which is one of the larger ETFs on gold. It's the biggest ETF for gold. And then you have the iShares Gold ETF too. So where traded, obviously, you can go down attribute by attribute. COMEX Gold's traded here at CME Group. The others are traded on securities exchanges like NASDAQ or the New York Stock Exchange. Ticker symbol GC versus GLD versus IAU. And the underlying, they all have gold physical as an underlying. Where I want to point your attention to, though, forget the dollar value. We all know the COMEX Gold dollar value is in the $130,000 range. The Spider Gold Trust is about $120 a share. And the iShares Gold is 1/100th of the ounce of gold. It's trading at $12.24 as of when I made this slide. But I want you to go down to the average daily volume, average daily dollar volume also. So those two columns are the ones that are most important. Let's see if I can get a little drawing here. So average daily volume for the COMEX Gold for last quarter of last year was 292,000 contracts. It was about 320,000 for the whole year. Average daily dollar volume is 37 billion. So the Spider Gold Trust trades 7.4 million a day. Remember, they're only about $121 a share. The notional value for one share is $121. The gold futures is 130,000. So contracts, they're very large, so the dollar amount is large. So if you look at the average daily dollar volume and compare the Spider Gold Trust, it's not even $1 billion. It's about 0.9 or 0.88. The iShares Gold Trust ETF does $0.1 billion. So the two of them together are just under $1 billion, whereas gold futures do $37 billion. So the futures contracts, while they only trade 292,000 contracts in the fourth quarter, they're 37 times the size of the two largest ETFs. And this is, again, the reason why is the very first slide of this seminar. Those 10 reasons why. They're all great advantages, and investors realize this, and therefore they come into the market because it's the most liquid. It's 24/7, and you get really good margin efficiency. So you put down about 4%. If you want to do margin with the Spider Gold Trust, it's Regulation T margins, the Federal Reserve Bank of New York, and that's 50%. So if you wanted to buy $130,000 worth of gold futures, you can do it and only put down $4,900. If you wanted to buy that amount of the Spider Gold Trust, you'd have to put down $65,000. Transaction costs, we have very low transaction costs, and this is because the notional values are very large and the minimum ticks are very small. So even though you have a 1 penny increment with the Spider Gold Trust, it's a smaller contract size too. So it comes out to almost more than 10 times the amount of transaction costs. It's still very liquid, very cheap to trade, but the futures are even more cheap. or can be traded even more cheaply. Management fee, gold has no management fee. Spider Gold Trust has 0.4% annually, and the iShares has 0.25. Now, if you wanted to roll a contract forward, you wanted to keep a gold futures contract strategy, whether it be long, a short, or a hedge, you would have to roll, and that would be a cost there. But most people are speculators in the industry, and they wouldn't necessarily do that. But if you had to roll, you'd have to measure your roll costs, and that could be 0.1, 0.2, 0.3, 0.4%, depending on what your costs are and depending on the bid-offer spread during the roll. 24-hour trading, you can do so in futures. If you want to initiate and offset a futures contract in the middle of the night or late at night or early in the morning, you can do so. Very difficult to do with ETFs and stocks. We have options on all three of them, and of course the last attribute, tax treatment, 60-40 treatment for the futures. You do not get favorable 60-40 treatment for the ETFs, either of them or stocks. We're going to skip this slide. It just shows the size of the futures market versus all the various types of ETFs, but we don't need to talk about that now. All right, just a couple quick things on gold volatility, then we'll go to questions. I want to bring this up because it's important for those that want to trade gold options at some point or options on gold futures. And just again, get a little bit more, get your arms wrapped around the gold market a little bit more. Up until the last 3 weeks, as you know, the U.S. stock market was in the volatility doldrums. Volatility is very, very low. It was in the single digits. Well, and then at the beginning of the month, beginning of February, 3-4 weeks ago, or first week of February, we had a major sell-off and volatility spiked dramatically. It wasn't just stocks. Everything was in a low volatility environment. If you looked at crude oil, you looked at metals, and you looked at the stock market, everything was trading near decade lows or generational lows, 20, 30-year lows. Stock market was near all-time lows in volatility. Gold, however, didn't spike too much along with everything else, and it was down too. You can see from this chart on slide 25, it's gone from 18% down to the single digits, 8%. So for those that are looking at options, volatility is pretty cheap. Now, we need an updated chart. We need to know what gold volatility is today. So that's something for you to look up and to compare on this chart. Has it rallied? Is it lower? Is it higher? Is it medium? Well, that's what the next chart is, chart 26, and this will be probably one of the last things we talk about. Volatility percentile rankings. Go back to college. These are the things that we used to do with college entrance exams. If you got in the 90th percentile, you beat 90% of the people that took the test. If you got in the 10th percentile, 90% of the people beat you. You only beat 10% of the people, and you probably either had to take the test again, or you didn't get to go to MIT or Stanford. Little joke there. Anyway, so the highest in the last 3 years that volatility has traded in gold futures options, 18.83%. The 90th percentile would be 17.14, so on and so forth, all the way down. The 10th percentile is 10.11%. The low is 7.96. When I ran this chart, volatility was running around 10%. So we were in the 10th percentile. That means 90% of the time volatility is actually higher in options on gold futures. So what does this mean to a trader? Volatility is pretty cheap. Could it go lower? Yes. If you just looked at the U.S. stock market for all of last year, it was cheap and it kept getting cheaper. Every month that went by, volatility went down and down and down. Then finally in February, it finally started to take off. Volatilities usually don't stay low for long. They will eventually revert back to where, they're mean reverting. But the whole crux of this chart is that if you're going to buy options, you want to try to do so in the lower percentiles, and especially the 10th percentile, options get really, really cheap, as you're going to see in a second. At the 90th percentile, volatility is dramatically higher, and what happens when volatility goes higher? Risk goes higher, and therefore premiums go higher too. So the moral of the story is, if you want to buy options, you want to do it in the lower percentile rankings, and if you want to sell options, you want to do it in the higher percentile rankings, all right? Just remember, if you sell options, you have unlimited risk in some cases unless you do a spread or a combination. So you better have deep pockets, and you better have really good risk management capabilities. And if you look at insurance companies, they are like option sellers. That's just a little bit different. Instead of selling an option on some asset moving up or down in price, they sell an option to you, and they have to buy you a new house if it burns down or pay off on a life insurance policy. As a result, insurance companies, as you know, have very, very good risk management and really, really, really good deep pockets. So if you want to sell options, these are two things to be aware of. If you want to buy options, different dynamic, limited risk and pretty good unlimited return in some cases. But who's ever had an unlimited return? That rarely happens. But you can have substantial returns, 6, 7, 800, 10 times your money, 20 times your money. But buying options carries little to no risk on the downside, except for the premium that you pay. So let's look at the second or the third column here now, the at-the-money straddle in premium terms, and then we'll look at the last column, the at-the-money straddle in U.S. dollar terms. So let's go down to the 10th percentile. When I made this chart a few weeks ago, the at-the-money straddle, which would be like the 1250 or 1300 straddle, it was trading at $5,000. Look what would happen if volatility started to go up and it just went to the 50th percentile. In other words, volatility went from 10% to almost 15%. That straddle would have gone up dramatically from $5,000 per straddle to $7,500. If you're long, that's great. If you want to get short in low volatility environments, though, you can look at the potential for loss. What would happen if we rallied to the 90th percentile? From the 10th percentile, you go from $5,000 for the cost of the straddle to $8,700. That's pretty wicked. That's a substantial loss of capital, as they say. And if you don't think you can go to the 10th percentile to the 90th percentile pretty quickly, look at the U.S. stock market in February. It went from the first percentile, I almost said the 1th percentile, the first percentile to the 90th percentile in 3 trading days. It did most of that damage. It went from the 10th percentile to the 90th percentile in 2 trading days. So when traders get scared and emotions run high and world markets get volatile, you can traverse a whole bunch of these percentile rankings rather fast. So be careful. If you're going to buy options, do so in low volatility environments. If you're going to sell them or take your profits, do so in high volatility environments. And remember too, before we get to Q&A, just because you buy something in the 10th percentile and volatility goes up to the 25th or 50th percentile, does this guarantee you're going to make money? No. No, no, no. Remember, options carry, you got to think in 4 dimensions. You have to worry about up and down, time to expiration, and volatility. Well, if volatility goes up, that helps your position. But what if it takes 2 months for volatility to go up? Then you have 2 months of time decay working against you. So you have to be careful. It's like 4-dimensional chess or 3-dimensional chess. You have to look at all the variables. All right? All right, so we're about 52 minutes into this. We got 8 minutes left. We staged it for about an hour. We'll stick around for some questions if anyone's got them. So we'll poll for questions here. So feel free in your dialog box to ask questions.
While you're typing in questions, I just want to go over really quickly the details of the Ready, Set, Gold promotion that the CME Group is conducting. So it's a 5-day competition. It puts you and a big universe of traders in a live, risk-free trading simulation environment at the CME Futures Institute page. So you would go to institute.cmegroup.com/gold challenge, and for the details. So it's not a TradeStation event, but we urge you to take advantage of the contest and certainly to get to know more about the CME Futures Institute. Looks like we do have some questions. Dave, what are the key takeaways from the gold presentation today? The key takeaways. So on the top 10 reasons, of the top 10 reasons, you what would we say? You didn't rank these necessarily. I thought this was interesting. What does it mean that futures are the first responder?
Oh, good point. Yeah, I didn't elaborate on that because I went into the tax efficiency of futures. Excellent question. First responder meaning futures are very, very sensitive to underlying economics and underlying moves, elections, geopolitical events. war, terrorism, everything. Perfect example. We're going to go way back in history. Let's go back to 1989, 1990, when remember when we were not doing so well, the United States, along with Iraq, we were not getting along too well. And there was a news conference, and there was Operation Desert Shield, and it eventually became Operation Desert Storm, and we had this very short war with Iraq. Well, there was a news conference between James Baker, the Secretary of State at the time, and Tariq Aziz, who was the Foreign Minister for Iraq. And they got up and they had a joint news conference. They were both standing up there, and they said, Baker says, regrettably, we could not come to terms with the Iraqis. All the market needed to hear was regrettably. That's all they needed to hear. They didn't even need to hear the rest of the sentence, because by the time the rest of the sentence got out, the S&Ps were down 17 full handles. Nowadays, that's not a lot, but back in 1990, 17 full handles was a lot. There was a big, big movement. So futures will sometimes move very, very quickly, because you basically have one futures contract. You have thousands of users all over the world, all on basically with front ends that attach into the Globex matching engine, and they're very, very responsive. To move the S&P cash or the Dow Jones cash, you have to move, 500 stocks, 30 stocks. There's 3,700 stocks that trade on the floor of the New York Stock Exchange. It takes a while for those to catch up. Now with computers, you catch up pretty quickly in a couple of minutes, but it used to take 15, 20 minutes. During that Tariq Aziz news conference, when they said regrettably, it took 15 minutes for the S&P cash to catch up and be down about 17 points. So they're very, very, very responsive.
Sean has a question for you. He's asking, do large governments like China, Russia, India use these futures to buy gold for delivery? And if so, how can traders tell if they are buying or selling gold?
Okay, we never are able to comment on who our users are. That would be like saying, who are your biggest customers? We can't do that. It's illegal, for one. For two, I'd get in trouble. But suffice it to say, we have an entire branch at the Merck that deals with central banks. All we do is go out and educate central banks, work with central banks. We know some of them trade interest rate products. We just don't know which ones do what and what size they do. It's a Chinese wall at the Merck there, so to speak. And I'm not privy to that data. I can say that in some cases with some products, central banks can trade futures. I'm not so sure if they do it with gold, and if they do, there is no way to find out if they're doing it. Unfortunately, you just don't know that. The Fed doesn't telegraph itself. The European Central Bank doesn't telegraph itself. They don't make announcements. So there's reports that go out once a quarter or once a year, and you can see foreign central bank holdings of gold and things like that. But in terms of futures, there's nothing that I'm aware of. That doesn't mean it doesn't exist, but there's nothing I'm aware of.
The Commitment of Traders report?
The Commitment of Traders will tell you futures contracts. It'll tell you large open interest holders. It'll tell you who's large shorts, commercial shorts, and all that. But I don't think there's an entry there for central banks.
Okay, yeah. That's a great question. The presentation itself has been recorded. It will be available on the TradeStation website and in Video Station and on the YouTube page. Sometime later tomorrow, we will get that posted up for you. But the slides, can you be contacted?
Yeah. Can they still see this?
Yeah, sure.
Oh, they don't have my email address.
All right, so
can we put that up
yeah,
there?
what do we have?
David.Lerman? Not up there. Unless it's somewhere else.
One moment. We'll put Dave's email here for you. Give me 1 second.
CMEGroup.com. Group.
Okay.
Oh, you got it. Spelling. Group. Your keyboard does what mine does. Sticks. There you go.
All right.
Yes. Feel free to email me, and I will be very happy to send people out either a PDF of the slides or just the slides themselves. Okay?
All right, everybody. Let's get back to trading today. It's midday here in the Chicago area. The Dow is up about 270 points, and had some active trading today. Thank you so much for spending time with us. And thank you, Dave Lerman from the CME Group, for spending time with us today. It's been a wonderful presentation. We hope to do more of these down the road.
It was my pleasure. Be happy to do as many as you want down the road.
All right, great.
Thanks, Don.
All right. All right, everybody. Thanks again.
Wow, up 277.